I've been tracking the gold market for more than 15 years, and what is happening now is different from anything I've seen before. On the 28th of January, gold hit $550.89 an ounce, breaking through areas that seemed impossible a few months ago. But it is no longer a matter of Wall Street insiders moving money behind closed doors. Regulars, your neighbors, colleagues, people you know who are now buying more bars at Costco. They are opening precious metals accounts. At the same time, central banks around the world are engaged in what can only be called a gold accumulation race, and most people don't even know it exists. I spent 2 months investigating exactly what caused this. The answer is not a reason. More interesting, a perfect storm of 5 or 6 factors at once. If you're uncertain about gold or worried about missing opportunities, everything you're about to hear will change your view of the market. Let's talk about numbers that most financial channels don't even discuss. The scale of what happened is almost incomprehensible. Gold prices soared 6 to 5% in 2025, giving us our best annual performance since 1979. Consider the nearly 50-year time frame we're talking about now. But there was something more striking. 53 separate record prices that year. This can be broken down into new records about every 7 days, which means that if you look at the price of gold every week, you'll hit a new high almost every time you look. Now, the demand data I found made me pause. In the first quarter of 2026 alone, global gold demand reached a record $19.3 billion. We are not talking about physical quantity here, but pure monetary value. That is more than the annual economic output of many countries, with more wealth distributed to gold in 3 months. And when I delve into the reasons for that number, the answer is fascinating. Gold purchases increased only 2% year on year, which means that the price itself is the main reason for the rise in gold prices. In 2025 alone, gold-backed exchange-traded funds attracted $89 billion. We're talking with a capital B about billions of dollars, not millions of dollars. By the end of 2025, the United States held 219 tons of gold ETFs, equivalent to $280 billion in retirement accounts and portfolios across the country. From this perspective, the amount of gold is equivalent to about 3 full years of global gold production and exists only in investment accounts in the United States. To understand what happened next, you need to understand a conflict that began on the 28th of February when the United States and Israel launched a joint military operation against Iran. I am not talking about politics here, but what matters for our conversation is how the price of gold reacts. Historically, gold and geopolitical tensions have followed a straightforward pattern. Fears have soared, money has been diverted to gold, and prices have climbed. This has been a reliable formula for decades. At the start of the conflict, gold holdings appeared to immediately jump to $5,327 an ounce in a week, causing the kind of volatility expected in a major international crisis. What followed shocked almost everyone who followed the market. March is here, and despite the active Middle East war, gold's monthly performance is the worst in more than a decade. Despite expectations of gold's performance in times of geopolitical instability, gold has fallen sharply. After market analysis and mining with some industry insiders, the explanation has become clear. Once the initial shock subsided and the market dealt with what had happened, investors realized that the system had not collapsed. Liquidity remains available. Financial infrastructure continues to play a role. There is no catastrophic collapse that forces people to hold gold at any price. This means something different. Traders who rushed to buy gold positions in anticipation of unlimited returns suddenly faced different realities. Panicked buyers began taking profits. Institutional investors betting that gold will continue to climb have begun to liquidate their positions. When large institutions began selling, retail investors were spooked and followed up, creating a chain effect. The real lesson here is that gold's response to war or conflict goes far beyond headlines. It is actually sensitive to market positioning, investor expectations, and what happens when reality does not match expectations. Central banks don't treat gold the way ordinary investors do. They don't try to time the market or catch a rebound in trading. They actually scared, and that is why they buy gold. As early as 2022, The United States and its allies made a decision to fundamentally change the world's view of monetary reserves. They froze about $300 billion in central bank assets. No negotiations, no doubt. They just froze it, and the money could not be withdrawn. These assets become worthless to the institutions that own them. Now consider this moment from the perspective of all the other central banks in the world. If you're managing China's central bank, India's central bank, Brazil's central bank, Poland's central bank, it makes clear a cruel fact: if the political situation deteriorates, any wealth you hold in foreign currencies or in the foreign financial system could disappear tomorrow. This realization raises an obvious question. What assets are beyond anyone's ability? The answer is gold. This understanding triggered a chain reaction starting in 2023, accelerating to 2024 and continuing to 2025, creating a buying pattern not seen in decades. China's central bank has bought gold for 17 consecutive months, totaling more than 350 tons since 2020. This is a deliberate purchase of 1.3 million pounds of gold. In the first quarter of 2026 alone, they bought more gold than in any month of the previous year. Poland was caught in an unexpected situation. In 2026, they became the world's largest buyer of gold, accumulating 20 tons of gold in the first few months alone. But their promises went well beyond the initial purchases. They publicly announced plans to reach a total gold reserve of 700 tons, representing a clear multi-year buying plan. As I read directly from official statements, their central bankers actually said this: instability has become a defining feature of the global economy. Gold is a strategic asset. This is a clear statement from the leadership of the Polish National Bank that geopolitical risks are now permanent, and that gold is the appropriate response. Poland's buying spree is not happening in isolation. Uzbekistan increased by 16 tons over the same period, Kazakhstan by 6.5 tons, and almost every Central Asian economy has embarked on a similar accumulation strategy. All these countries recognize the same fundamental problem: the global financial order is collapsing. Sanctions may be against them, and the physical gold in their vaults represents insurance. The other side of the coin tells a different story. In 2026, Russia sold more than 15 tons and Turkey sold 8 tons. But their motives were very different from those of buyers. Russia faces wartime spending pressures, forcing them to liquidate assets. After years of economic stress, Turkey needs liquidity to stabilize its currency. Emerging from this divide is a fascinating pattern. Countries that feel relatively stable are actively accumulating gold as a geopolitical hedge, while countries facing economic or political pressure are forced to sell gold because they need immediate liquidity. In the first quarter of 2026, despite the sharp rise in prices, the central bank bought 24.4 tons of gold, an increase of 3% over the same period last year. Despite the sharp rise in gold prices, it has not slowed. They actually accelerated their purchases. The central bank's actions partly explain what is happening, but what about others? What drives people to buy gold bars at Costco or through online retailers? Gold once existed in exclusive spaces where ordinary people could not really participate. You need to call a specialist dealer in rare metals. You have to understand the technical details of spot prices and premiums. It costs a lot of money. The whole process feels complicated and inaccessible. When major retailers started selling gold bars, that changed completely. Online platforms make buying incredibly easy. You can now buy an ounce of gold coins like anything else, because the process itself is a simple business. In the first quarter of 2026, Stickcoin investment climbed to 47.4 tons, the second highest quarter in history. Only Q1 surpassed it a year ago, when fears of geopolitical escalation and inflation were operating in a near-panic mode. When I started asking people directly why they were buying gold, several consistent reasons kept coming. The first reason is outright economic anxiety. The economic environment has indeed changed meaningfully. Inflation was a concern last year and remains a concern this year. The central bank spent 2025 raising interest rates, which means bonds and fixed income investments cannot provide the returns they once provided. The stock portfolio has experienced considerable volatility. Real estate prices remain at historic highs while borrowing costs are rising. When you look at a typical diversified portfolio of stocks, bonds, and real estate, you start to notice something troubling. All three asset classes are fundamentally linked to economic conditions. When economic problems arise, they can fall together. Gold works by a completely different mechanism. It is tangible. It is really scarce. No one can print more gold. No one needs permission to own it. Second, geopolitical risks are being hedged far beyond what is happening in the Middle East. Trade tensions are rising. The sanctions regime could expand unexpectedly. Regional conflicts could spread. There is a potential feeling that the world order is becoming less stable, and that gold works if something, whatever the reason, disrupts the financial system. Third, I think this factor is underestimated in most conversations about the real liquidity of gold. You can sell gold anywhere on Earth. There is no need to find specific buyers. You can walk into almost any coin store and sell it right away. Online markets keep quoting. That liquidity has become increasingly valuable as people age and begin to seriously consider protecting their wealth rather than chasing returns. Fourth, I should never ignore a behavioral factor. In 2025, when gold rose 6 to 5% to a record 53%, the metal became a cultural conversation. Your financial advisor mentioned it. CNBC reports regularly. Your parents start asking about it. Gold has gone from what your grandfather collected to the hottest asset class of the year, and the narrative has shifted to real money for retail investors who want what everyone is talking about. Is this the most rational reason to buy gold? Probably not, but it reflects actual human decision-making and is certainly a contribution to the surge in demand. Here is what no one emphasized. Demand for jewelry has absolutely collapsed while retail investors and central banks have bought in large quantities. In the first quarter of 2026, jewelry demand fell 23% year-on-year, a record low in any quarter. The reason is simple: gold has become too expensive for ordinary jewelry. When gold is traded at $5,000 an ounce, buying a gold necklace as a birthday gift no longer makes economic sense. This shift represents some important factors in the market structure. Demand for gold has become more investment than decoration. This is a truly significant change driving up gold prices. Everything we've discussed so far has to do with a single underlying trend that deserves more attention than ever. The dollar is structurally weakening. The dollar's fall was not sudden or sharp. Throughout 2025, the dollar index, which measures the strength of the dollar against other major currencies, fell steadily month by month. This consistency is important because of decades of underlying economic relations. When the dollar weakens, gold prices strengthen accordingly. That matters. Gold is denominated globally in dollars. When your currency depreciates, everyone outside the United States thinks buying gold with their own money is relatively expensive. But that is only part of the story. A weaker dollar usually means that American assets are becoming less attractive to international investors. When that happens, global capital flows change. Central banks are beginning to shift from dollar reserves to other options. Emerging markets see opportunities. Fundamental changes have taken place in the investment model. A research report released by Goldman Sachs in early 2026 predicted that the dollar would continue to weaken throughout the year as demand for U.S. assets declined. Their analysis is not unique. Several major research institutes have reached the same conclusion. This convergence is striking. Real geopolitical uncertainty is tense. The central bank is actively away from dollar reserves. The dollar structure has weakened significantly, and retail investors eventually get simple gold through platforms such as Costco. It is the perfect combination of power. That is why everyone is buying gold now. Now it depends on the actual forecast of major financial institutions on the future price trend of gold. What I want to share is a serious institutional analysis, not speculation or speculation. J.P. Morgan Chase, the world's largest bank, has assigned its global research team to predict the direction of gold from an asset perspective. They concluded that gold could reach $6,300 an ounce by the fourth quarter of 2026. This is about 12% higher than the current trading level as of mid-April 2026. Their logic is straightforward and worth examining. As long as geopolitical tensions continue to escalate and are believed to escalate, And as long as the central bank maintains buying discipline, gold should continue to appreciate. They did not provoke an explosive backlash. They described a continuation of the upward trend that had begun. Goldman initially took a more cautious stance, predicting $4,900 an ounce by the end of 2026. But because gold actually beat expectations, their forecast actually rose several times. Morningstar's research team reached a similar conclusion, assuming that global conflicts remain unresolved and central banks continue to buy. Gold should perform well. Several major research institutions agree that the average gold price is expected to be about $4,900 in 2026. Higher than current prices suggest that professionals expect the renminbi to continue to appreciate, although the path will not rise in a straight line. The March decline tells us that gold can be unexpected. Its approach may run counter to conventional wisdom about what should happen during an international crisis. I need to be clear. These forecasts are not guarantees. They represent educated analysis based on current patterns and conditions. If the Middle East conflict is unexpectedly resolved, if things change, if Fed policy shifts to more accommodative monetary conditions, if other narratives attract market attention, these forecasts will be outdated. They demonstrate a legitimate institutional belief in supporting gold at higher prices. These are not fringe voices of wild prophecy. These are the world's largest and most credible financial institutions. Another noteworthy thing, gold has set a record with astonishing frequency. On the 28th of January 2026, we saw a historic peak of $5,589 this year. Most financial assets do not often hit record highs. Gold does this many times a year. This pattern shows that there is structural support behind the rise, not just temporary enthusiasm or speculation. Most people who talk about rising gold prices don't spend much time focusing on supply, but that is what really matters. Throughout recorded human history, we have mined about 216,000 tons of gold. This is every ounce taken from the earth. The current pricing puts the cumulative supply at about $29 trillion. There are 132,000 tons of undeveloped reserves underground. That is where the real limits lie, about 3,600 tons per year, and the reserves identified include about 40 years of continuous production. Gold will not disappear next year. But gold is largely limited. Such restrictions matter. You can't print more gold. You can't use quantitative easing to create extra gold. You can't do it. That is all. As the remaining gold dwindles and the cost of mining rises, the remaining gold becomes more valuable. This is why central banks and sophisticated investors maintain gold positions. You don't want to get rich from gold. You make money with inflation, government decree confiscations, or things created by the central bank. That is the practical use of gold in an integrated portfolio. Let me give you a clear summary of everything we've covered in the last half hour. Gold is not rising because of random sentiment or speculation. Reasonable structural reasons underpin what is happening. Central banks are accumulating money at historic levels to hedge against a breakdown in the global order and currency instability. Ordinary investors buy because they have access to simple gold channels and seek diversification in uncertain times. The structural weakening of the US dollar supported the rise in gold prices. Geopolitical tensions are still rising, and potential concerns about global stability remain. Even though the market's response is not exactly what traditional theories predict, supply dynamics have reinforced this long-term upward pressure. Can gold rise to $6,000? Maybe. If things change dramatically, can they go down to $3,500? Or maybe the market will not fluctuate in a straight line. We can honestly and confidently say that this gold rally is not a bubble. This is not hype. This is driven by forces deep into our financial architecture and geopolitical environment. Whether you own gold or not, whether you believe in it or remain skeptical, it is important to understand these forces because they are not temporary. The central bank will continue to hedge geopolitical risks. Ordinary people continue to seek portfolio diversification. The dollar will remain under pressure. That will not change anytime soon. That is the real story. If the collapse of gold market dynamics helps clarify what happened, click the subscribe button. We segment financial markets on reasonable terms without the usual hype or doomsday predictions. Thanks for watching. See you next time.